Yes. Hello. Good afternoon. Good evening, depending on your workstations. My name is Hugues Kamere. I work for the Secretary of Making Finance of Africa, and it is my pleasure to welcome you on behalf of Making Finance of Africa to this webinar, which will discuss the topic of efficient corporate governance for financial sector development in Africa. Now we have moved to our live session. So in terms of introduction, I would say that in general, corporate governance in the financial sector aim to put in place suitable procedure to reduce risk. Governance give priority to risk management in the recent year, and a number of initiatives and regulations that have been launched with the aim of promoting good governance in subsector of financial sector. I can name here the Basel Directive in the banking sector, the Solvency II in the insurance sector. We have invited a distinguished panelist from KPMG, Mr. Thierry Mbimi, who will walk us through this subject, and we would like to thank him and colleagues for their availability and support to this webinar series. Before handing over to the floor to our main speaker of today, let me share with you some practical information guiding the delivery of this session and some highlight on making finance work for Africa. Please, just could you go back to the previous slide? Yeah. Hello? Previous slide, please. Okay, so in terms of housekeeping, we would like to say these sessions will last for about 1 hour, including Q&A. We can extend maximum for 15 minutes, and to ensure a good quality of experience, all participants will be muted. The question can be submitted via the chat and the Q&A. You have the chat that is below the button that is below the panel. Live questions, comment, you can raise your hand and we will unmute you if possible. And also, it's important to state that the recording of the presentation will be circulated after we conclude this session. I think it's between somewhere between 48 to 72 hours. If you encounter any issue to connect to the platform, please send a message to the organizer, and we'll invite you to fill the form that will pop up automatically at the end of the sessions, so you can really fill in and give your feedback that we really value to improve the quality of our webinar. On making finance work for Africa, I think we have gone through on the outline of these sessions. I will quickly go over Making Finance Work for Africa presentation, which is a G8 initiative launched in 2007. It's a platform for harmonization and facilitation of financial sector development and sharing knowledge. In Africa, we bring together development partners, African government and private sector really to work and achieve this ultimate objective, which is to unleash the potential of the financial sector in Africa to drive economic development and poverty reduction. Next slide. The Secretary work along 3 strategic pillars, which are financial inclusion, long-term finance, financial stability, and governance. And we cover this priority by addressing a number of hot thematic like digital finance, SME finance, trade finance. Also, on long-term finance, we have the institutional investor, the housing finance, and then on financial stability or governance, we have established the Community African Banking Supervisor jointly with the Association African Central Bank. Knowledge management advocacy is cross-cutting pillar. Next slide, please. I will take this opportunity here really to express our gratitude to our members and our sponsor, which are the African Development Bank, our host, the German Corporation, the French Development Agency, the Afrexim Bank, EIB, and recently also the European Union that are supporting us. Without further ado, I will introduce our main panelist of today, who is Mr. Thierry Mbimi. Mr. Thierry Bimé is a partner and CEO, Chief Operating Officer for Central Africa at KPMG International. He also head the financial service, oversee financial service work in overall Francophone Sub-Saharan Africa. He has a very rich experience on this subject. His work before in Australia, Nigeria, and before establishing in Cameroon, where he really is in charge of KPMG work. I would now pass on the microphone to our main speaker of today, Mr. Thierry Bimé. You have the floor, please. Thank you. Mr. Thierry, you have the floor for your presentation.
Yes. Hi, good afternoon, everyone. Thank you, Mr. Hugues Kamewe, for the presentation and for introducing the topic. I recall a trip from Lagos to Abidjan, waiting for a flight and talking to someone and the person, a prominent investor in the region, questioned, and it was, given your experience in Nigeria at the time I was in Nigeria, given your experience, what's the biggest risk in the financial market and for financial banks? My answer did surprise him because it was corporate finance. And this is what it's going to be about today. And we will have 30-35 minutes of presentation followed by questions. My name is Thierry Bimé, and as said before, I've now been for 2.5 years here in Cameroon. Prior to that, I spent 4 years in Nigeria. Prior to Nigeria, 11 years in Australia, and 12 years in France, born in Cameroon. I am a consultant today, a partner at KPMG, but I also used to be a banker myself, notably creating the equity derivative desk at ANZ Investment Bank in Australia, trading derivatives. I will endeavor to take you through corporate governance, followed by the key players and governance structure, the financial sector development and corporate governance, risk governance, and board governance. After which we will have the questions. Next, please. Next. So the first part is about corporate governance. The next slide, we have a different definition of the definition of the role of corporate governance. I will, before continuing, I will just mention that the presentation has many slides, but we will ponder more on some than for the others. The understanding is that you will receive the presentation thereafter, so you'll be able to go through some graph that are in the presentation. So the one of the definition of corporate governance is to monitor performance, advise the CEO, and provide connections with a broader world. Another we can see from the IFC is corporate governance is defined as the structures and processes by which companies are directed and controlled. The way I look at corporate governance is that, for me, corporate governance should be to the executive what central banks and regulators are to the financial system. In other terms, for me, it is really what drives the bank. Everything is from the top, and from the top we go to bottom. If corporate governance is not where it's supposed to be, the bank or the financial institutions will not go where it wants to go. Next. The evolution of corporate governance has been marked by, unfortunately, financial instability, meaning that it has almost always been reacting to the financial markets. We can, call it the Great Depression, 1929, after which the Keynesian and monetarist policy was born, etc., etc. The most recent one was the global financial crisis in 2007. At the time, I was a trader, and I remember the pain we had on the desk because we did not have at the time the proper processes in place to monitor those type of risks. Followed that GFC, we had the creation of the Dodd-Frank Act and the Basel III. We will come back to that. The benefit of corporate governance is to optimize operational and financial performance, improve access to capital and investor support, mitigate risk and safeguard against mismanagement, efficiently allocate and manage resources, build and improve the reputation of the company, create confidence, establish goodwill, and build investor trust. The last one is very important because the investors and shareholders are key, let's say, stakeholder in the life of financial institutions. Example of corporate failures in the next slide. You can see many, but we can't, because it's a presentation in English, we can focus maybe on those close to us, notably in Nigeria, where we had government models that were created thereafter. I can call in 2003 and 2011 the SEC code, the CBN code 2006, 2014, etc., etc. I can name failures. Okay, we had Afribank, Spring Bank, Olympus, Tesco, and of which we had lesson learned. In the next slide, we have some failures, additional failures of banks in the next slide in Africa. We have, for example, 9 bank failures in Ghana, okay, UT Bank, Capital Bank, Unibank, etc. 6 banks failures during the 2009 Nigerian banking crisis. We had Nozo Banco in Mozambique. We had Crane Bank in Uganda, and a few more. In the next slide are not updating, so I don't know if it's me or if it's Ghana in corporate governance, regulatory reform, example of the Ghanaian banking sector. So those are some examples of regulatory reforms from the Ghanaian banking sector. However, it does also suits for the rest of the continent, notably with the IFRS 9 impairment, the implementation of the Capital Requirement Directive, the Corporate Governance Directive, and the Ghana reference rate. There is also the first one, the increase in the minimum capital requirement for banks. It is the next slide. So
Oh, okay. Yes. Oh. Yes, allô?
Oui,
Oui, on t'a
Oui.
perdu là.
mais je suis toujours, moi je suis toujours connecté.
Ton audio, c'est... Ok, je vais essayer de voir avec Yves. Ok.
C'est comme si,
Ton audio, essaye de voir ton micro. Ok. I think he's back and he will manage to connect. Thierry, can you hear us? I can see that you are connected. Your mic is open. Are you back, Thierry?
We hello?
Okay, we can hear you
Yes,
now.
I'm back.
Yes, thank you. I'm sorry. We apologize for this inconvenience. Yeah, this is technology, and we will pass on the floor to the presenter, and he will continue with his presentation.
Yeah, my apologies for this. So what I don't know where I lost you, but I presented the failure and responses in the banking industry. And I mentioned the 9 banks failures in Ghana, the 9 bank failures in Nigeria in 2009, and a few others. And I also mentioned the regulatory reforms in the Ghanaian banking sector, notably around IFRS 9, the implementation of the Capital Requirement Directive, the Corporate Governance Directive, and the Ghana reference rate, and also the increase in minimum capital requirements for banks, where I stressed the fact that for capital requirement and liquidity requirements, central banks in the continent, in the region, and more so in sub-Saharan Africa, are more and more stringent in their requirements. For capital adequacy, it's about ICAP, Internal Capital Adequacy Assessment Process. And for liquidity, it is about ILAP, the Internal Liquidity Adequacy Assessment Process. The next slide is about key governance challenges facing the banking industry. The banking industry is evolving, and a question is, that remains, but for which I think we have the answer, is corporate governance adequately equipped to face all these challenges? The biggest is to ask ourselves if the bank of tomorrow, the bank of the future, more so here in Africa, will be the one we have known, the brick and mortars. Some other banks, like without naming names, in Nigeria, have already started their journey into digitalizing most of their banking application and processes operation. When we talk about corporate governance, we have agency problems. And in this case, there are 2 agency problems between the upper management and the shareholders, and between the central banks and regulatory bodies and the shareholders. To those agency problems is to ensure that interest and independence are what they have to be in order for the boards of directors to do the job. This brings us to the end of the first part about corporate governance. We thought we will put for each question, for each part, some questions from the board. What you have there is to take home, is to help the board to challenge the executive, notably the CEO, regarding all those different chapters. For example, what is the corporate governance definition best suited for our environment, the most recent failures, etc., in order to adapt corporate governance for the bank. If we go to the part 2, which is about the key players and governance structure, we have the ecosystem and stakeholder of the company. You can see that the business is in the middle, but you have suppliers and subcontractors, clients, supervisors, supervisory authorities, employees, social organizations, unions, you name them. The key players, however, the next slides are the regulators, the shareholders, the management, the board, the employees, and other stakeholders. We have here employees because they play a critical role in ensuring corporate governance is what is supposed to be. The structure, the suggested corporate governance structure, the next slide, comprising the following parties, provide a comprehensive framework. It is to enhance accountability to shareholders and other stakeholders. Often and often, I've been presenting to boards, and in front of me, I was having either people that were not adequate for this type of presentation, for example, on risk management, or we did not have alignment between the board implications and, for example, the type of committee or the matter that was discussed. And that's why accountability is very important to shareholders and to stakeholders. Ensure to timely and accurate disclosures of all material matters. Deal fairly with shareholders and other stakeholder interests, and maintain high standard of business ethics and integrity. Again, as you remember, the tone, it is the tone at the top that will drive the tone throughout the company. The next slide is about the corporate structure, corporate governance structure, where you have the board of directors, the board committees. In some legislations and in the banking sector, for example, you have compulsory committees, okay? For example, risk committees, credit risk committees, audit committee. Here you have the list of few of them, and you have a company secretary. You have internal advisory council, not always, but it comprises experts in economics, business, and finance from around the world, acting as advisor to provide the board with expert insight and perspective. It's often that this advisory council is missed in our boards in the region. You can have consultative panels, okay? You have management committee, and you have shareholders and other stakeholders. The next slide is about the diagram. It's illustrative, which position more or less the board of directors, okay, within this ecosystem of shareholders, stakeholders, external auditor, etc., etc. So that's the next slide. It's just an illustration, but you will have time to go through it. For the sake of the presentation, we will go to the next slide, where we will talk about key elements of an effective governance system. Now, that system needs to have board practices, well-structured board with appropriate composition, skills, and independence. Clearly defined appointment process, well-structured committees of the board, just to name those few for the board practices. Another key element of the corporate governance, of an effective corporate governance system, is the stewardship, with periodic stakeholder engagement, continuous and transparent disclosures of financial and non-financial information, equitable treatment of shareholders, and protection of minority rights. The last point is very, very, very important: protection of minority rights. Then the following element is corporate culture, with effective process for managing conflict of interest, related party transaction, and insider trading. Another element is risk and control environment, to clearly document framework for risk management and internal audit, dedicated risk and audit committees with oversight on assurance functions. We will come back to risk governance because it's one of the most important elements of this pie. The last element is strategy, where we need to have the board involved in strategy formulation. Again, the top is the tone at the top, and whatever the company is the responsibility of the board. We need to have regular management reporting on strategic initiative and a healthy challenge and debate of management assumptions. That brings us to a conclusion of this second part, where we thought we will provide you with a set of questions from the board in order to challenge the executive. That's the next slide. Again, all these questions are a kind of, let's say, cheat sheet for the board in order to challenge the executive and also to challenge themselves. The third part of this presentation is about financial sector development and corporate governance. What is the next slide? What is the impact corporate governance for the financial sector development? Next. The factor contributing to financial sector development. Some common causal factors. Some causal factor can be identified to inhibit to financial sector development. It's about rapid financial sector liberalizations and supported by measures to encourage prudent risk management, inappropriate and unsustainable macroeconomic policies such as loose monetary policies and excessive fiscal spending, exchange rate arrangements that lack credibility, poor transparency and accountability, industrial protection and policies that impede efficient allocation of resource in the economy, and weak corporate governance has contributed to financial instability or to inhibit the sector development. The next slide is about the summary of cause for weak corporate governance. The causes of weak corporate governance are fourfold. It's about the lack of board independence, okay, the non-regulatory compliance, the internal audit failures, and the poor credit risk management. Now, about lack of board independence, the chairman of the board serves on majority of. We have insufficient number of independent non-executive directors. The board does not drive ethical compliance across the board. No evidence of board evaluation and external reviews. The independence of the board is very important. I take an example. If you need to have, for example, a credit to be granted, okay, to an obligor or for an obligor facility, okay, it is important that the level of approval, okay, is where it's supposed to be. Okay, the board should not be involved where it's not supposed to be involved in the approving process, in the approval process for a credit, for example. Okay, but what you will see, it's often you will see board interference in the process, and that's the reason why in the region we will end up with NPL very, very high. Now, on this board independence and even accountability, we had to do an analysis of the reason. Okay, we did a diagnostics at one of the biggest banks in the region, and we wanted to know why the NPLs were so high. It was very strange, not surprising, but strange. But anyway, it was of a surprise from the board and the executive management that we had a correlation between the high NPLs and the approval levels. And it was at the managing director and board approvals levels where we had the highest NPLs. So non-regulatory compliance, the compliance unit did not implement a framework to coordinate the accurate and timely issuance of reports. Okay? Now, here too, it's very easy to fix it because we now have tools that help us to be compliant. We have automated rule, automated compliance operations, etc., that can be implemented in banks. Poor credit risk management, so I touch a bit on it regarding the lack of board independence, non-compliance to loan approval, more or less, more often than not, the approval process is not respected. And the last one is about internal audit failures. Remember at the beginning of the presentation, I mentioned that one of the biggest risks, if not the biggest, was corporate governance. But even if you go further down, and we'll see it in risk management, is that the next biggest risk for me in banking is not credit risk, but it is operational risk. Why? Because those risks are being crystallized by human errors and lack of processes, which is of the realm of operational risk. The next slide is about how KPMG looked at corporate governance framework. You have the details, it is documented, so I will leave it with you, but roughly it's around 4 pillars. That's the next slide. The pillar 1 is around leadership and strategy. The pillar 2 is about performance monitoring. The third one is about accountability and audit. Next slide, please. And the pillar 4 is about communication with stakeholders. Performance and monitoring is also a very interesting topic, and we will come back to it when we talk about risk governance. Yes, what we have here is what to do to build an effective corporate governance in banks. Those are few pillars that we need to, few components that we need to look into. The governance operating models, the terms of reference of board and subcommittees, the executive management and management committees, the governance culture, the governance monitoring and reporting, and the secretarial practices. You have the subcomponents of those elements to build an effective corporate governance in banks. If I take, for example, the governance structure, what we have, the governance culture, okay? We need to have employees' knowledge and understanding of the bank value, employees' competencies and practicality of KPIs targets, the belief and commitment to the bank's risk management processes. Now, very often, culture is neglected, okay? Despite that it's a qualitative, let's say, concept, okay? Not quantitative like credit risk scoring. However, okay, again here, for me, is one of the most important elements. When you would go into a bank that work normally, you will find that the risk managers, in fact, are everybody in the bank. Why? Because the risk culture is throughout, is permeable, and it's you can find the bank. It's not just the risk department under which is supposed to cater for risk management. The next slide is about way forward for financial sector development. What is it that you need to fix in your bank or your financial institutions in order to have corporate governance enabling the financial sector development? You can look at corporate governance maturity, do an assessment and a benchmark. You can look at your governance framework, design, development of corporate governance policies and procedure. You can look at the board and subcommittees' effectiveness, at the board training programs. You look at the governance culture. You can do a review of it. You can develop internal control framework. You can look at your enterprise risk management framework, and you can endeavor into a compliance transformation. There's a word that captured my attention here. It's procedures. Okay. How do you change culture in an organization? some people would say that, again, it's a qualitative concept, but you change culture by changing your processes. You put control in place in order for the procedures and the processes to be aligned to the behavior of your staff and to the culture you would like your bank or insurance company or financial institution to follow. This is the end of the third part about financial sector development and corporate governance. When we saw some key elements to put in place and different triggers to push in order to have an effective corporate governance serving the financial sector development. Also here, you have some questions that the board can ask the executive management in order to ensure that the executive management is doing what it's supposed to do. The second last section is about risk governance. Again, for a long time, risk has been at the back, if you want, okay? But more and more, you have risk that is coming up and which is no more being used as back office or middle office, but as a tool to help the front office, but also to drive the bank performance. Without going into too much details here, if you want to fix your risk governance from a risk, if you want to fix your risk governance, you have to look at five points, okay? The first one is risk appetite statement. How much risk the bank is willing to take. That will have to dictate the type of business the bank will have to go into. Okay? Do we want to do speculations? Is our risk appetite low, medium, or high, et cetera, et cetera. The delegation of authority, we talked about it in the credit approval process, okay? It needs to be well-defined and with accountability and responsibility. Delegation of authority that allows for timely and accurate decision-making. Risk limit monitoring. In line with the risk appetite statement, the bank should know from a regulatory point of view where are our threshold, and also from a business point of view where are our threshold. What are our risk limits in terms of ratios, capital adequacy ratios, liquidity ratios, NSFR, LCR, et cetera, et cetera. Risk return based decision making. When is the last time in your bank to take a decision, took into account risk? Your front office is bringing you a deal that will make a revenue of, let's say, 2 billion. Have you asked that front office staff how much risk is embedded in those 2 billion? Because if you have 2 billion of risk and 2 billion of revenue, the net gain is zero. Risk return based performance evaluation, risk adjusted return on capital. When you invest, the next time you invest, let's say 1 billion in the bank into a new business or a new product, or maybe Islamic banking, okay, if you're not yet into, okay, you need to ask yourself, what is my risk adjusted return on capital? And to base your decision on such a factor. There exist several others that adjust the allocation of capital based on the risk embedded in the different decisions. We also did this work for one of the banks in the regions, and we had many, many surprises. Some branches, for example, that were thought to be very successful, in fact, were not, when we adjusted their performance to the risk they were bringing into the business. The next slide is about banks face many risks, of which operational risk is key. Remember, I told you corporate governance is key. And then for me, next to corporate governance in the region, it is operational risk. Why? Because risk that you find in credit risk, for example, they are not risk inherent, for example, to the computation of those of the credit worthiness, for example, of the obligor, okay? But there are risks that are crystallizing because, for example, we did not respect the covenants, we did not respect the approval process. It is a process problem. It is an independent problem. People, it's often also a system process, a system problem where the system did not work as intended. The next slide, the two next slides, is about, you have there, next slide. It is a summary of BAL 2, okay? This slide and the next one, okay? It's a summary of BAL 2 and 3. Now, we will not go through this, but those are the foundations of risk governance, of which BCBS has even built 13 principles. Now, why this BAL 2 and BAL 3 is important for us? In the region, in the continent, some countries are more or less advanced, but we were talking about implementing BAL 2, for example, in Australia in 2004. Okay. Is to tell you that, okay, we have some catch up to do and we can do so. It is not about implementing word to word, but the principle of the regulation. Risk governance, okay, a key enabler to effective corporate governance system is the establishment of a risk governance framework, where, again, repeating myself, we have to look after the risk appetite, the delegation of authority. Do you have a delegation authority policy in the company, in your bank? Do you have risk limits and monitoring in place, risk return-based decision-making, and risk return-based performance? Next. Next, you have the principle of corporate governance, okay? Bearing in mind time, I will leave it to you to go through it. But if I were to pick only one, I'll pick the principle number 11, which is compensation. Very often, compensation is not in line with the performance. So very often, compensation is not used to drive behavior. So this is also an area where in the continent, we need to spend a bit more time. And you have a list of 5 slides about OCWE, about questions from the board. Okay, next slide. Okay. Yeah, next slide, please. You have a question from about generic, then about the risk appetite. The next one is about the risk management. Okay. The next one is about stress testing, which is a key part of risk management. And the last one is about capital adequacy. And I could add liquidity risk management too. Those are a set of questions for you. It's not for them to you, but for you sitting at the board in order to challenge your executive and to ask them, for example, okay, where is the risk concentrated? Okay, what are my top 3 risks? What are the triggers in order to reduce those risks? This brings us to the last part about board governance. Remember, we are talking about corporate governance. Corporate governance, board is the one driving corporate governance. However, the board itself needs to have its own governance. What you have here are the different types of ineffective boards. Do we have a rubber stamp board where, for example, most of the decisions are done by secularization, okay? So whereby the board does not meet, okay? Do we have a myopic board, okay? Short-term needs of investor considered, neglecting the long-term interest of shareholders, okay? Focusing on financial impact, lack of diversity of the board members, tendency to micromanage, or do we have a board that is the dreamers, okay? Inefficient focus on current issues, fail to identify and or manage key risks, and realistic optimistic. Next. key element of an effective board, okay, you need to have a balanced board. You need to have a defined governance structure and practices. You need to have an effective board dynamics and culture, effective board leadership. For example, do we have a CEO that is also the chairman of the board? Question mark. You need to have clarity of role and responsibilities. Who is sitting at what committee and with what independence and accountability? You have to have a board evaluation and renewal process. In the regions, it is compulsory to have that board evaluation, okay, on an annual basis. However, in the sub-Saharan Africa, many countries, in many countries, this is not done properly, despite the fact that it's a regulatory requirement. If you do all these, you will have an effective board. The next 3 slides are just detailing what that effective board is in terms of, okay, a balanced board team, defined corporate governance practices. You have pointers there that you can look into in order to ensure that, for example, you have those, that effectiveness of the board. If we go to the slide 51, what does an effective board look like? Characteristic of an effective board, okay? We need to have awareness of its mission, okay? Professionalism, independence and ethics, strategic vision, regular updating of knowledge, etc., etc. But above all, what you need is commitment, character and integrity. That's slide 51. Interpersonal relationship and strategic thinking. These were the characteristic of an effective board, where you will find again commitment, integrity, strategic thinking, and interpersonal relationship. You want to have people at the board that will challenge the status quo, that will be proactive, that will have a vision. The next slide is about what stakeholders expect from the board. Stakeholders expect from the board compliance and loyalty, independence of judgment, no conflict of interest, undiluted professionalism, and fairness. Again, we can go into details, but we can leave it to the questions. Okay? The next slide is about questions, this time to the board, in order to challenge them, okay? Do you think your board is effective? What type of governance you have in your board? Do you have the credentials necessary to drive the company in line with the bank, for example, risk appetite and performance targets? The next slide is about the conclusions. And I will spare you reading the different bullet points. I will just read the quote at the end to conclude. If a board is to fully fulfill its mission to monitor performance, advise the CEO, and provide connections with a broader world, it must become a robust team on whose members know how to ferret out the truth, challenge one another, and even have a good fight now and then. This is the end of the presentation. Hugues?
Oh, yes. Thank you very much, Thierry, for this very excellent presentation, very comprehensive, detailed presentation on the subject. There's a lot that we have done, and I'm sure this is a very valuable asset that the participant will take from this meeting. I think that was your main objective. We have received. I take this opportunity also to invite the participant to submit the questions. We have received a few for the moment, and I will read it for you. Read them for you, Thierry. The first one that we received was that, can group policy take precedence in an environment where the regulator failed to specify the ideal governance structure for the financial sector, or where the regulator is dormant? So you have the floor.
Yes, the regulator is. I mean, we can talk about regulators. It's a topic on itself. What's the role of the regulator for corporate governance and even for the financial sector performance? Okay, now group or the bank governance should first should be twofold. Okay, should be in line with the regulatory requirements, and where the regulatory requirements are not sufficient, should implement processes and policies in order to be in line with the company target and performance. An example, for example, is cryptocurrencies. Today, there is a void from a regulatory point of view. What do your board has decided in regard to cryptocurrency today and tomorrow? So again, it's twofold. You have to respect the regulatory requirements, but also you have to go further than that if the regulatory requirements are not sufficient.
Okay. Thank you. Yes, thank you, Thierry. I will read the second question that I received. If it is about, can COVID-19 cause a revision in the governance structure of the financial sector, or a rethink to ensure the effectiveness?
Well, that's a very good question. And it's very topical because, okay, we can talk about COVID-19, but we can also talk about the previous crisis, okay? And more often what happens, for example, here around the COVID, is that is because of the COVID that now most banks and institutions are realizing that they have not revised their business continuity plan for a long time. Their contingency funding, for example, or their capital adequacy ratio is not now in line with the risk because they did not do proper stress testing. So definitely COVID or the crisis should help us to enhance corporate governance. However, there is nothing new today that we didn't know before COVID that we are supposed to do. So if we did apply enterprise risk management properly, okay, the framework, and put in place policies and procedures, we should not have for those who were hit badly, those bad hits, because those risk management principle would have helped us to downplay those COVID impact. And I can tell you, for example, about the focus. For example, your plan should focus on the safety and well-being of the company employees. You need to have a focus on financial risk and scenario planning, duration, severity, and long-term damage. You need to understand your key operational risk, particularly those affecting supply chain. You need to ensure that the board of directors remains informed of the company response plan to the crisis. And you need to evaluate the implication for financial reporting and disclosure. Okay. Today, for example, those few points needs to be done by response to the current crisis. Hugues?
Thank you very much. Another question is that the role of specialized committee, should they be standing or ad hoc committee? So, hello?
Yes, yeah, Hugues. Okay, about specialized committees, okay? Now, in companies of a certain size, the creation of committees is essential for the board to function as efficiently as possible. Now, the delicate point having then been studied beforehand by the committee, which provide the board with their insight and recommendation, okay? In addition, in the financial sector, in our sector, you have, as I said before, certain committees are compulsory and therefore must exist permanently and not in an ad hoc way. I'm talking about the risk committee, the audit committee, the credit risk committee, okay? In addition to mandatory committees, a sound basic rule is to create a specialized committee only if this meets an actual need of the financial institution, current or foreseeable in the short term. Yeah. So it is often good practice to create ad hoc committees where the need is. Hugues?
Okay, thank you very much. Another question that we have here is, if the board of directors represents shareholder, how to ensure and guarantee its professionalism at any time and protect all stakeholder interests?
Now, if, sorry, can you repeat?
Yes, with pleasure. The question was that if the board of directors represents shareholder interests, how to ensure and guarantee its professionalism at any time and protect all stakeholder interests?
Including minority interest, yeah.
Yes.
Now, this is why we talked earlier about the agency problem, okay? Now, in saying that, okay, to claim good governance, okay, it is fundamental to have a sufficient number of independent directors, okay? It is important to have sufficient number of independent directors, okay, who by virtue, okay, of their independent qualification provide a form of guarantee, okay, in the defense of the corporate interest and that of the director. Now, a good practice is to put independent directors as chairman, okay, of the specialized committee, okay. Another good practice is when the same person combines the function of chairman, okay, and CEO, okay, is to appoint another director as lead director, who will come and kind of balance in that power, that overpower that the CEO has, being the chairman too of the board of directors. In all this, we need to ensure independence. That's the key of solving this minority interest and agency problems. Hugues?
Yes, sorry. Thank you, Thierry. There are a few questions that have comes in between. Another question that we received here was, what measure should professional body adopt, and in bracket, beyond academic and career talk, to help improve corporate governance culture in Africa?
Yeah. Now.
Have you heard?
Yeah, definitely. It's very good. Okay. What is done, okay, by professional bodies, and I can even enlarge these professional bodies and others, okay, is, and even banks, okay, is to challenge, to keep challenging, okay. One of the key points is training, okay. We need to train people that are sitting at our boards. It's a reality, okay, that our boards of director, sometimes, I'm not saying always, but sometimes, or on some boards, you'll find people that really do not have their place at the board, but they are there for other interests, okay, representing another interest, etc. But if the investor is serious about the bank, he should appoint that will help to drive the bank performance. So what can be done is training. What others can be done, professional bodies, and including regulators, we can challenge regulators in order to come up with more stringent or more adequate regulations, okay, in order to regulate the corporate governance, the board. For example, I think it was back in 2015, where in Nigeria, we then have as a requirement, regulatory requirement, to have the chief compliance officer to be sitting at the board. Okay? So to give him the importance which is required, okay, to him and demanded in order for his voice to be heard, which was not the case before. You had board meetings without any representation of the chief compliance department. So we can do trading. We can challenge the regulators. We can also directly challenge the board. We can organize seminars. We can organize webinars like the one you're organizing, and all this in order to drive corporate governance. It is also important to point out that corporate governance, because of our peculiarities, if the principles are the same in applications, it could be a bit different to, for example, other jurisdictions like the one in Europe or in Australia or in the US.
Okay, thank you, Thierry. I think there's another question that came in and related to the COVID. It said that, read that COVID has slowed down activity generally, which has affected the job of regulators and corporate auditor. How can a regulator functions more effectively remotely and equally ensure corporate officers are held at the highest level of accountability? I think that one's quite interesting. You can repeat if you need, or you have understood it.
Yes. Well, if I understood it properly, is so how can we? Well, I mean, how to mitigate the impact of COVID in for the work the regulators are doing and corporate governance? Is it correct?
No, it's more like as they are working remotely, yes, how to help them at the high level of accountability. COVID has slowed down activity generally, which has affected the job of a regulator and corporate auditor. How can a regulator functions more effectively remotely and equally ensure corporate officers are held at the highest level of accountability? That's the question.
Yes, I guess it is, even though we work remote, the processes are the same, okay? So we need to apply the same processes we used to whilst we were working in-house. However, in this case, is remotely. From personal example, I mean, the most important thing has been signing, okay? Because at the end of the day, we do processes, we grant credit, etc. We need to sign. Of all I've seen, okay, if we were prepared, again, I come back to corporate governance, okay? And normally the bank should have been prepared. But we saw banks that did not have sufficient, let's say, security in the IT system in order to work effectively remotely, okay? So if the bank was prior to COVID, okay, working and the regulator, okay, normally with sufficient bandwidth, with sufficient, let's say, communication tools, okay? For example, now everybody is using Teams, but before COVID, we didn't know about it because we didn't think we could. But we now realize that we can do things with Teams. Jobs have stopped, okay, when COVID came. But then we realized that, oh, by the way, we can continue because we can even be more efficient working remotely. So it's just a matter of taking the right decision by to cascade it down and to tell people how they should work. But I think if anything, COVID has brought to us more accountability in our way to work, and I even think more efficiency. Yeah, more efficiency. Yeah.
Okay, thank you, Thierry. And maybe I've not seen any more questions. I was just asked this last one from me. Which place would you give to this corporate social responsibility in the robustness of a governance system in an institution?
Now, corporate social responsibility can take many forms and colors, but for having worked overseas and Africa, I can tell you that corporate social responsibility has the meaning and that it is supposed to have here in Africa. Therefore, it should be inherent to the corporate governance framework, meaning that CSR should be one of the priorities of the board. We are a continent that is changing, okay, that is restructuring from a different point of view, from different angle, and where corporate social responsibility is very important. Not only from helping the ones that are more in need, but also from a behavioral and a cultural point of view. So it really has its place within the corporate governance framework, and it should have the attention that it merits.
Okay, thank you. If you allow me to abuse a bit of your time and also your knowledge, we have said a lot on in the presentation on the banking sector. What is really specific in the banking sector? In your last word, would you have some comments that are related to maybe to risk management or this? I mean, the governance that is applied to the insurance sector, to the security market, or maybe the pension system. Any comment that you may make so that we can really cover all the subsectors of the financial sector?
Yeah. Thanks a lot, Hugues. Yeah. The comment I will make is that corporate governance is a set of, let's say, principle, processes, framework, is a way of doing things. And therefore, it does apply word for word for any type of financial institutions. Where you have a difference is when you talk about, for example, risk governance or risk management, where, for example, as you pointed out in your introductions, you have Solvency II in the insurance sector, okay? And you have Basel II-3 in the banking sector. But at the end of the day, conceptually, it is the same thing. The same presentation, and in fact, I did it for both environments, for all environments, pension fund, and the rest, okay? So this presentation can be applied to insurance, pension funds, asset management, private equity, banks, investment banks, et cetera, any type of financial institutions.
Thank you very much to this very comprehensive presentations. On that last word, I think we would like to express our gratitude to you for this enlightening presentation and this very extensive conversation that we have. I think we all agree that this presentation has been, this webinar has been very productive, and that we have done justice to the subject. Of course, there might be some still some questions that or aspects that have not been covered, do not hesitate to send us a question. We will channel it to our speaker, and then we'll manage to respond to you. Please join me in collectively thanking our distinguished panelists of today and KPMG for this contribution and their support to this webinar series. I would like also, on behalf of Finance of Africa, to thank our global audience for this continued interest in our webinar, which has been very intensive over the recent year. We have done more than 105 participants at any time following this presentation, which is a very high record numbers, and we are very pleased for that. And we encourage you to continue being our supporter. For your information, the presentation and the recording will be made available within 72 hours maximum. And finally, do not spare time and just spare 2 minutes to complete the questionnaire that will pop up automatically when you leave the platform. We value your feedback to improve the delivery of our webinars. You see the secretarial contact details that are there available. You can reach out to us at any time. You also have in the presentation the contact detail of KPMG and our speaker. So we are accessible. On this word, I would like to close this session and thank you again for your participation. Stay safe and bye-bye for now. Thank you.